In the previous video, we learned how fundamental analysis helps us understand whether a company is financially strong. But even if a company is great, one important question remains. When is the right time to buy the stock? And when is the right time to sell it? That's where technical analysis comes in. In today's video, we'll cover the fundamentals of technical analysis in a simple and beginner-friendly way. So, let's get started. The first concept in technical analysis is price action. Price action simply means the movement of a stock's price on a chart. Technical analysts believe that all available information, including news, earnings, and market sentiment, is already reflected in the price. That's why they study the price itself instead of trying to predict the news. By analyzing price movements, investors can understand whether buyers or sellers are in control. They can also identify potential opportunities before making an investment decision. And that's why price action is considered the foundation of technical analysis. After understanding price action, the next step is identifying the trend. Markets don't move randomly. They usually move in an uptrend, a downtrend, or sideways. An uptrend means buyers are in control. A downtrend means sellers are stronger. And a sideways trend means the market is moving within a range without a clear direction. One of the golden rules of technical analysis is to trade with the trend, not against it. Following the trend often increases the probability of making successful trading decisions. Another essential concept is support and resistance. Support is a price area where buying interest tends to increase. This often causes the price to stop falling or even move higher. Resistance is a price area where selling pressure tends to increase. This can make it difficult for the price to continue rising. These levels help traders identify potential buying and selling opportunities. It's important to remember that support and resistance are not exact prices. They are zones where price reactions are more likely to happen. Another important tool is trading volume. Volume shows how many shares were traded during a specific period. It helps investors measure the strength behind a price move. If a stock rises with high trading volume, the move is generally considered stronger and more reliable. However, if the price moves with low volume, the move may not be as convincing. That's why experienced traders always analyze price together with volume. The final, and perhaps the most important topic, is risk management. No investor wins every trade. Even the world's best traders experience losses. The difference is that they know how to manage those losses. Before entering any trade, you should always decide how much you're willing to risk, and never invest all of your money in a single stock. Protecting your capital is more important than chasing quick profits. In the long run, good risk management is one of the biggest keys to success in the financial markets. And that's a simple introduction to the fundamentals of technical analysis. If you enjoyed this video, don't forget to like, subscribe, and share it with someone who wants to learn investing. Thanks for watching, and I'll see you in the next video.
Please subscribe and don't forget to hit that bell.